We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I am here today with Stefan Tsvetkov of RealtyQuant. I had to look down and get the name of the company because I was so focused on not messing up the last name that I wanted to make sure that we got it right. So,
Doing great.
Stefan, how are you today?
Casey?
Oh, doing wonderful. So, Stefan is here. He's going to talk to us a little bit. So, I think there is this little bridge that's constantly being built between the old school ways of underwriting and community analysis and overall market analysis, specific market analysis. And Stefan has some tools that give us the ability to do some of that digitally and using a number of different data points and some other stuff. And then we were talking a little bit about some of the AI that's involved on the property side. So anyway, Stefan, I'm going to let you kind of tell us a little bit about what your background is, where you come from, and how you got started in this. And then we'll kind of go forward and let you tell the listeners, what kind of stuff maybe your company offers and go from there. So
Yeah,
take
absolutely.
it away.
So myself, I am a financial engineer in my previous career. So I had a career in finance for about a decade. I'm Eastern European originally, so I came to the States at 22. I did like grad school in New York City in financial engineering, and then I was working like as a derivatives trader, derivatives portfolio manager in finance. For some of your audience, they may know what it is. It's kind of like trading options and futures and, like different financial instruments, right? So that was my job before for about a decade. And in the recent like few years, I've been a real estate investor in the New York City area, in like different like residential projects more, as well as more recently like commercial out of state towards the Midwest, actually. So that has been like my background as an investor. I also have an analytics company called RealtyQuant, where we do like different data driven. I do like different data driven methods essentially. And the one product we now have for the public is kind of market data. So like gauging like different like over undervalued markets, like price forecasting and things like that.
Okay. And so what I guess the big thing for me, and this is something that you and I were talking about, um, what's data aggregators are something that really it makes so much perfect sense to me, but at the same time, I always get confused as to which data is important, and especially when it comes to commercial real estate, like what give us an example or two of what data points can be used in specific markets and what that gauges that's useful to commercial real estate.
That's a great question. Well, one thing on the property side that I found very useful, which is how I do my off-market commercial multifamily, prospecting, if you will, is using rental listings
Yeah.
data to kind of gauge value add across different, commercial off-market commercial multifamily. And so the way that approach
Okay.
works is so if you have something like data from be it like CoStar's or other apartment finder or realtor.com, whichever rental listings information you have out there, you can sort of use that
Okay.
data at scale across thousands and thousands of commercial multifamily. And I did a lecture for my own webinar where I showed like kind of studying 32,000 commercial multifamily properties in different markets and kind of trying to predict which ones of them are going to have the biggest value add. So that's an example of a data-driven, call it, like you said, like new approach versus like the older school approach, right? The some ways in which this
Yep.
can be good, in my experience, is, well, one thing is, okay, you can discover properties that have rents below their immediate neighborhood and property cost, let's say rents that are out there. So they're sort of for the same property cost, same neighborhood, having rents below market is the more obvious component. But then there's more insights that one can derive from rental listings information, and it's kind of a unique approach, actually. I mean, I don't want to say unique, but a relatively, it's not something I have seen out there as far as an approach to studying commercial multifamily, I feel. But I think it's a good one. And so another thing is, like, you can look into like what fees those buildings are charging. So let's say you can look at, like, are they charging pet fees, administrative fees, like all those other income components, and you can look at like what utilities they're charging, and sort of perhaps even from rental listings gauge the approximate occupancy in a way, like based on how many units are coming out on the market, and things like that. So in those terms, you can kind of
Yeah.
build a simple model in which you try to assess, okay, between all those factors, what's going to be the percentage improvement in NOI that you can realize on a given commercial multifamily property compared to other ones in the same market, let's say. And yeah, so that's so it's like it's
Yeah.
a
Yeah.
fairly not a fairly not complex approach, but it gives you in a way and it's very approximate, since, I mean, obviously you don't have the actual income expense sheet of that property, but it's a way to sort of get a
Yeah.
preliminary glimpse into the income expense sheets of thousands and thousands of properties. And then you can say, okay, perhaps I can, if you have direct to owner campaigns and or agent relationships, whichever approach it would be, but you could kind of gear your
Yeah.
marketing or efforts towards specific buildings that are bigger value, or perhaps you could also prospect in 5 different markets, just the top 20% in those markets. This kind of makes for like kind of more
Yeah. Yeah.
intelligent
Yeah.
marketing. So that's on the property side, like one kind of modeling of the off-market inventory, rather than just like getting the data feeds and just like blasting campaigns to those data feeds, kind of like having like more financial modeling of it. And so that's one thing. As far as the market side,
Yeah.
it's quite interesting because, well, I mean, there is obviously some market data from CoStar, and so forth. But now, is it big enough to be able to get like big information, like across like the US, for let's say every single county, every single market, and so forth, which is generally my approach on the market side. I like to have the big picture for every county in the country, something like this, and kind of like compare. And so
Yeah.
what I do myself for the market side is it's actually just studying the housing market. It's not the commercial multifamily inventory. Now there is I also did a study of like,
Okay.
okay, what has been the correlation of like CoStar's NAREIT index, I believe, is the name, and let's say FHFA home prices, and okay, over the long run the price correlation is like 91%. So kind of over the long run they are supposed to move together. Now, as we know, in the short run, this is
Okay.
different. It deviates. We have like some commercial multifamily declines after global financial crisis, for example, perhaps being more moderate than in regular home prices terms. But again, it's just for me to have like a relative measure and understanding across like different markets. I just look at the regular housing market, so the regular like residential properties. And the way to do this is like doing fundamental analysis on income, population, and housing supply. And
Okay.
so I did a back study for the global financial crisis, and then this has been the basis of like market data that we publish at my company, RealtyQuant, which sort of gives like downside risk and appreciation predictors for like basically every county in the country. And so to gauge downside risk, so before the global financial crisis, if one did like an analysis of income, population, housing supply, or let's say proxy it with more simple, let's say, affordability deviations versus a moving average window, like things like that. So one would have predicted the declines, let's say the state level declines, to around 85% correlation, which is pretty high. And one can see like actually very easily, like I've done like many lectures on this topic actually at this point, where it's like
Okay.
okay, where if you look at the map of how different US states were valued at the time, and for example like California,
Yeah.
Florida, Nevada, and Arizona were like the ones that declined a lot after the global financial crisis, and so they were valued at like 40 to 60%, like deviation from where they should be historically, so to say. And like, and what their declines
Yeah.
were actually, which were like, I think like 41 to 56 were the exact numbers in like those four states. And so it's like pretty in line. And then you go to like all the undervalued states, which was actually, even Texas was undervalued at the time, and they had like only a 4% decline. And so, which is like, so it was very interesting, like to see like this kind of study. And then I did like the same study for like every county at that time as well, and correlation drops. It's harder to predict small geographies, right? It's like now you have like every single county,
Sure.
correlation is now maybe around 75%. So it gets like less predictive, but it's still, you're predicting small geographies. It's like 75% correlation. It's, pretty good. So,
Yeah. See, and that it doesn't take long to get over my head. I know, as far as
mm,
when you start talking about a lot of what
okay.
correlates with what, and that's where I get lost really quick, because
Mm,
like I said,
yes.
before the show, is like, I've always wondered how some of these places use
Okay.
like how many jars of peanut butter they're selling, and then all of a sudden they can tell you, other things about the market that you just never even dreamed
Uh-huh.
from that one statistics. Uh, but so one of the biggest things that I have been ultimately like very curious about, especially in the last, like, say,
Mm,
probably year to 18 months, has been how the flood
mm,
of
mm,
people from California has affected, like, how hard is it to predict what communities are going to grow, because ultimately at the end of the day, when California starts shrinking, everywhere else
mm,
starts growing. It happens every, what,
mm, mm.
12 years, 15 years, something like that, seems like. um and so when they start leaving, how hard is it to predict what then is going to start growing? Because like, it's almost like a lot of those people come to, and
Mhm.
I'm talking in very general terms, obviously, but a lot of those people leave there and they stop in,
Yes.
like, let's say, Utah and Colorado. Well, then the people in Utah and Colorado go to Kansas, Arkansas, and then the people from Kansas and Arkansas go
Mhm,
to
mhm.
Nashville,
Yeah, yeah, yeah.
Atlanta, and it's like a
Mm, mm,
wave. And so I think the predictability of some of that stuff has been, I think, what's
mm,
escaped all of us. And I think that's why some of the tertiary markets, the markets that are outside of the main Nashvilles and Kansas Cities and Atlantas, the even the
mhm.
smaller markets, the
Exactly.
sub markets have grown, and the prices and the
Mm,
rents are
mm,
basically out of control. But um, how do you how does that become
mhm,
either
mhm.
predictable
Yeah,
or
that's a great
unpredictable?
question. Well, I think it's very hard, like to your point, right? As far as when the trend changes, like when there is a change, and if the trend reverses in some direction, then it's very, very, very hard. Now, whenever, to the extent, if we take Colorado or Utah, and to the extent that there was already a price trend or population, well, I would say a price trend is actually easier to predict. And like, so let's say price trend in Colorado or Utah is kind of driven by like some of the outflux from California, in that direction. And so to the extent that it's already there, for a few years, then it's been fairly easy in recent years to predict the growth in those same places. So just for the record, now that kind of might
Yeah,
sound obvious,
yeah,
but it's
yeah,
actually impressive how I did like a price forecasting just at the state level. Okay, just like it's a simple comparison. And so at the state level, if one was trying to predict, okay, where prices grew in 2018, 2019, in all those different states, Colorado, Utah, everything else, right? Yeah, the error that I had
yeah.
versus the real growth was like only 1.4%. when they use like 45 years of history.
Wow.
So while the trend is there, that's
Wow.
just something to note. It's not so hard to predict. It's less hard to predict prices than our intuition suggests. Now, whenever the trend changes, we have 2021, there's massive inflation. Okay, then that kind of falls apart. Now suddenly the
Yeah.
error is, I don't know, 7-8% or something. It's too big. And so that is kind of some of that. Now as far as reversing in the trend, it's very, very hard. That will be like more complex machine learning methods. There are various things that people do to try to predict neighborhood appreciation. There was a company called Lofty
Yeah.
AI. They switched to more like tokenized real estate.
Mm-hmm.
It's a prop tech startup, and they were doing like neighborhood appreciation based on social media signals. So what they were trying to see is, for example, if in X neighborhood, if the breed of dogs, for instance, changes, or yeah, like things like that. Okay, let's say you had like whichever kind of dogs, now you have like a
Right.
new kind of dogs that are more associated with like higher income demographic or something, right? So but it's more like the change of it, and like things like that. So, but then it's hard because I mean, then what they're actually doing is they're testing like which of those predictors actually work, which are the ones that actually predicted appreciation, and so it's a lot of work in that sense. So I would say like reversal in the trend is very hard. As far as while the trend is there, it's relatively easy in most markets, and it depends where you are again. If you're in Alaska or something, and Alaska had a negative momentum, if you will. Like momentum, like price momentum gets
Yeah.
measured in statistics by something called autocorrelation. Like how correlated is like this year price growth versus last year price growth. So
Yeah.
Alaska had negative momentum, call it by this, but most U.S. markets, like shouldn't say markets, states, and then markets within them, like markets within Florida and Texas and even Massachusetts, had very high momentum. So like Florida momentum at the state level is like close to
Okay.
80%, and so that's like something very.
You're talking momentum of
The
price
momentum of price
increases, right?
increases, exactly, of the price growth, yeah, sort of
Okay.
price
Okay.
growth in the
Okay.
current year versus price growth in previous years, let's say. And so that's quite interesting, and because that is the case, it's actually, so there's trend, so it's actually forecasting. Sometimes it's not very hard. Now whenever the trend changes, it gets like very, very hard. Now if we try to forecast population, like you said, I
Yeah.
think that's actually harder. And so if we try to forecast, are people going to move to like different places? That's, I think, very, very hard. And then how much of that is going to tell us something about prices? Well, population, even at the state level, how much is predicted prices? Like 40% only. It's not that much. It's good. It's okay.
Wow.
But now you have to add other things on top of it. You have to add income.
It's definitely you have a
Yeah,
lot.
you
You have
have
a
to add
lot of other
other stuff, and then it
data
gets
that you can
better.
use, I
Exactly.
guess.
But and there is another thing. So another study that I did is, if you, let's say you took all the fundamentals of real estate. Now, what are all the fundamentals? Perhaps income, population, and housing supply. Maybe. I'm just thinking. Let's say what else? So
Yeah.
let's say those are
Yeah.
like the three big fundamentals in my mind. And so you take income, population, and housing supply. You try to forecast each of those separately, where population is going, where income is going to grow, and so forth. And then off that to forecast real estate prices. And I did that, and I
Yeah.
found like 5 times bigger error than if I just forecasted prices themselves. So that's another like thing. It's like very impactful, because what that means is, if you have like say a syndicator, and they pick their market, and they're gonna say
Yeah.
Atlanta, let's say Atlanta, Georgia, because has this population growth, this income growth, perhaps job growth, all these variables. Inherently, the reason why they pick it is because they want that market to grow, right, to experience appreciation. But in doing so, in
Yeah.
selecting that market based on those fundamentals, they are actually committing a 5 times bigger error than if they just took the prices in Atlanta, Georgia, and just assume that they're going to continue to grow the same way. And so forecasting, yeah, so it's kind of
Wow.
interesting. So it actually makes it even easier. Well, of course, it depends. Now, if we were in 2012 or 11, and the market cycle hasn't even begun, there's no trend whatsoever, your only way to forecast anything would be to look at the fundamentals and forecast prices of that. But while we are already like 10 years in the
Sure.
trend, 8 years in the trend, and so forth, the best bet for people to forecast markets, at least based on what I've seen, has been just to follow the trend, So like Phoenix grew and Austin grew and
Yep.
so forth, and just like and it's still
Well,
growing
Phoenix
now.
is still growing. It seems like inflation didn't do anything but pour gasoline on Phoenix and just
Right,
explode. I mean, it's
but
just
it
been
it
unbelievable.
grew
So,
from go
uh,
ahead.
here here ab- about I'm going to say
Mhm.
3 or 4 years ago. So in the individual real estate agent sales business, and as my listeners are well aware, I always reference this because I have a great deal of experience in that side of things. But there was a company that, and I don't even remember the name of it right off, but it was
Mhm.
an artificial intelligence company who specialized in predicting whether somebody was going to be selling their home in the next 12 months. Now, that company was ultimately
Mhm.
acquired by Remax, I believe, and they had a considerable amount. And supposedly, obviously, if they were acquired by a company such as Remax, they obviously were on to something. And there was considerable amount of stuff going on behind the scenes. But what they specialized in was, so what you would do is you would upload your list of, they would give you like so many uploads a month. You could upload, like, let's say 100 new names per month to their platform for their fee that was associated with it. And as your list grew, they would analyze those contacts, and they would give each one of them a predictability score of whether or not they were going to
Mhm.
list and sell their home in the next 12 months. And as I bought it for 2 or 3 months just to see just to get an idea. And ultimately, it was like, as a lot of people know, real estate agents have no patience. So I was like, well,
Mhm.
this isn't working fast enough. When, in fact, 90 days to tell me anything about anybody was reasonable. But the thing is that they had these data points, and supposedly had data points on my contacts that could predict whether they were going to be moving in the next 12 months based off of, I'm assuming, different, like
Yeah, yeah, yeah.
different websites they were visiting, or
Mhm.
different things they were posting online, or whatever the case is. But let's dive a little bit into that, because I think one of the biggest parts of the commercial real estate business right now is the off market
Mhm.
property. That's like the holy grail. The off market property that the mom and pop owned
Mhm.
200 unit apartment complex that's not on the market, and they're wanting to retire and it's for sale, and nobody else knows it except for this one person. That's the holy grail. So how does how does I guess there I guess I'm just
Mhm.
curious overall, how does that work? Like, how do you predict, start on an individual level, how do they
Well, I
predict
think it's
somebody's going to
just,
sell?
I mean, it's not something because I kind of specialize more like on the financial analysis side, I guess. But let's say that's kind of motivated
Okay,
sellers, right? Like motivated sellers. So, I mean, if you have, so
sure.
just like I think they look for signals and kind of test how predictive they were. So if you have, I mean, let's say the most obvious perhaps signal, and usually it's not that, but often for off market, if something was actually an expired listing, right, or if something was actually listed before, okay, so now
Yeah,
that's an
sure.
obvious signal. Okay, that person actually is
Yep,
motivated. He wanted to sell, or she wanted to sell, but it didn't work out for whichever reason, and so but it shows like some kind of motivation.
yep.
So expired listings are a big one, and from there, like there's like all those life events, right? Like if somebody is going through a divorce, or somebody is going through like different hardship, where is the relative depth on their property versus like the current market values. And it's just like all those signals that make it more and more likely that somebody would be willing to sell. I think there is quite a bit of supply on that if you think about it, like in terms of like prospect.
Let me put some context behind this real quick to add to what you're saying.
Yeah.
After I canceled my subscription to the app, I followed it, and I
Mhm.
followed probably the top 10, and I'm going to say they were about 70% for the next 12 months. Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cashflow Pro part of your day. Now, back to the show. The 12 months after that, they were about
Mm.
70% of
Uh,
predictability
I see.
wins, I guess,
Well,
if you
that's pretty
will.
good.
It was
Yeah.
unreal.
Well, I guess I'm not sure which the app was specifically, but yeah, I mean, I think that's a useful thing. I would think there are many tools that do that, though, in a way, because there's like say even like Prospect now, like some of the big like off-market data vendors, that's kind of what they do, right? They just kind of give you only the inventory with the owner information,
Yeah.
and then okay, what's the sense as to motivation, the seller. But I think it's like to the discussion, just like some of those signals, like are there life events or like how is the overall financials of the place working? And um, mm, I don't think it's too complicated, to be honest. I don't
Yeah.
even think. Yeah, yeah.
Yeah. Well, it may not be too complicated to you, but it sure is to us. It seems like
Mm,
we have a it's such a interesting process. But I didn't mean to get you onto
mm,
something you didn't specialize in, and so one thing that I want to uh,
mm,
the one term that you said earlier that I wanted to go back to, and you
mm,
mentioned CoStar several times, um, and I think CoStar is one of the um, sites that is a commercial real
mm.
estate whatever any type of commercial real estate activity that you're doing. CoStar is a great program, and how do you buy like backside data from them or something, or is it something that's available to everybody in order to go in and look and see and talk, and what is
Well,
that, what do you do there?
I mean, one can have subscription to their analytics and so forth. But as far as rental listings, it's not offered. It's not really
Yeah.
offered as a data service. I looked into it, and there's like a few like smaller vendors. So uh, I use like a vendor called Data Affinity, and there is also a few other
Yeah.
like on the property analytics. Like there's various small other vendors like Melissa and like Melissa API and like some other ones that kind of give you like some of the property data. If you wanted to sort of construct something like do your own prospect now, if you will, there's like ways to sign up for like
Yeah.
some services, but it's not directly from CoStar, and I would imagine it would be like very expensive if it was available. So it's kind of more like third party
Sure.
vendors.
Sure. Yeah. Well, and there's
Mhm.
apartments.com. I mean, they have, and I guess I'm assuming you can do some
You
scraping
you could
there if
yeah,
you
you could
if you really
scrape
want to.
directly the data. Now it's obviously it's bigger legal liability, or you could go to different third party vendors
Yeah.
that they source that data in whichever way, which may include scraping.
Yeah.
So but
Yeah. Well, people used to think the internet made the world go round, and the internet makes the world go round, but the data gives it the feel to go around. I
mhm.
mean, it's the data is has become far more valuable, I think, than any
Yes,
of us
yes.
ever even. The people that were early into the data game of trying to make things work and figure it all out were the ones who
Mhm.
really had it figured out themselves. So, well, listen, Stefan, I want to get to a couple of questions that we ask every guest. They're all the same. There's no right or wrong answer. The first question is, what is the best book that you have recently read or are currently reading?
Uh, Good question. Well, one of the best books I read not recently, like during undergrad, is a book called When Genius Failed. It's kind of like on financial markets. It's a book on
Yeah,
like the 1998, I guess, like Russian debt crisis and like long-term capital management collapse, which was like a hedge fund at the
yeah,
time. Um, yeah. Mhm.
interesting.
It's called
And it's called what? What
When
was the name of
Genius
the title again?
Failed. Yeah,
When
yeah.
Genius Failed. Wow, that's interesting. What is Dream Vacation that you've either taken or hope
Mhm.
to take?
Good question. Yeah, I think any vacation to a warm destination at this point, even though it's getting warmer in New York City now for sure. So generally,
Yeah, it's getting warmer here. It was getting warmer here until yesterday, and we woke up and it was like 58 or something, and I was like, "Wow, wintertime's back."
yeah, I mean, I like the Caribbean.
So,
It's my favorite
um,
always. I mean, it's kind of a cliche to U.S.
oh,
people, but to me, it's kind of my
yeah,
favorite.
yeah, but
Yeah.
there's a lot of beautiful. Until the last few years, I did some map studying and so on, and there's a lot of really
Uh-huh.
like you can start at Turks and
Mhm.
Caicos and Bermuda, and you can go to a lot. I don't know if those are necessarily considered
Yeah.
Caribbean or not. I guess they probably are. Um, but either way, yeah,
Yeah.
it's all beautiful down through there, and one of our favorite places, or one of my favorite places
Mhm.
rather, is was Aruba, which I think
Yeah.
is far South Caribbean. But anyway, Stephen, tell the people how they can tell the listeners how they can reach out and get in touch with you. I know there's going to be several questions about the AI and about some of the data stuff that you've got and that you have access to, especially since it directly correlates with commercial real estate. So how can the listeners
Yes.
reach out and get
So
in
my
touch with you?
website, realtyquant.com. So I think so. Like I mentioned, one thing they can find there is market data for every U.S. county, so around 2,700 U.S. counties. So there's like price forecasting, and what I find personally is more important now is there is downside risk predictions. So there's sort of if we reach market peak of market, how over under fair the valuator is every county in the U.S. and it's a very useful thing to have when picking your markets today. I feel so. Mhm.
Sure. Okay. Well, that's realtyquant.com. And why don't y'all go check out his website and look at what he's got to offer. And if anybody needs anything, reach out to him or reach out to his company. I know they'll be glad to help. So, Stefan, thank you so much for visiting with us today and giving us an insight into what all of this stuff that we hear so much about, at least a few definitions and things that maybe the folks can use to further their real estate
Thank you.
education. So thank you so much. Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.